All right, hello, welcome back into the NetPicks Options Express. In this video, I'm going to walk through some of our trades from last week. We'll take a look at a couple of trades that we closed out for profits, and then we'll also take a look at a handful of new positions that we put on towards the tail end of last week. The tricky part about this market right now is that we are stuck in the summer doldrums. We're stuck in a low volume environment, very much a low volatility environment as well, and it makes it tricky to find the frequency of trades that we're looking for. There's still things to do, but you've got to be a little bit more directional right now. You've got to be a little bit pickier on how much premium you're collecting, because it's very easy to get stuck this time of year into getting into those trades where you're risking 5 or 6 to make one. And that's what we want to try to avoid. We very much want to be cautious of our risk to reward scenario. So we'll talk about some of those new trades from the end of last week, how we piece them together, that we can get a feel for what we're looking to accomplish going into next week. Before we get into the new trades from last week, let's talk briefly about the 2 trades that we closed out last week. And what you're looking at here on the screen, this is our position sheet from the owner's website, and this is our closed trades column here. What you'll notice is we did close out of 2 trades last week, one on Costco and one on SPY. The reason these trades were so powerful, both these were short call spreads that we put on back in mid-July. Since then, the market has done nothing but move higher. We've seen the market make new all-time highs. The tech sector leading the charge to the upside. We've seen very little selling market-wide since we put these trades on. Anytime that you sell a call spread, the whole goal there is to benefit from either a sideways consolidation or a pullback to the downside. The reason I love to sell spreads like this is you don't have to be perfect on the timing of the trade, nor do you need a big directional move in your favor. If I were to buy a long put instead of selling a call spread, both of those are bearish positions, but the long put, you absolutely have to see a move to the downside. With the short call spreads, we give up the home run profit potential, but in exchange, we give ourselves many ways of making money. So what I'm going to do, let's go over to the chart. I just wanted to show you the details of both of these trades, both on Costco and SPY. Let me minimize this for a second. Let's take a look at SPY here first. This is just a simple daily chart that way you can get a visual of this trade, both what we did to put the trade on and how we accomplished the profit here last week. Looking at this chart of SPY, back on July 20th, we came in and we sold the 281.5, 282.5 call spread, and we collected 41 cents or $41 per spread. This position expired on Friday of last week. However, we did not hold to expiration. Going back into last week, at least the first couple days of last week, we had some earnings numbers out on some of the tech names. We did get some selling. It wasn't anything significant, nothing that lasted for more than a couple hours at a time, but it was enough to allow us to close out of this position with a partial profit. For those of you that might be newer to this whole concept of selling premium, when I say that we're selling a call spread here, what this means is I'm selling the 281.5 call, and at the same time, I'm buying the 282.5 call. That way it's a risk-defined trade regardless of what happens here. If I'm dead wrong on the trade, I know what my maximum loss is right up front. And my maximum loss in this trade was $59 per spread. That's all the capital that was required to put this position on. So you can do this with a small account size. If you have a bigger account, great. SPY is one of the most liquid products in the world. You could put this thing on with 50 spreads and not have any problem getting filled. The 41 cents that we collected to put this trade on, that's the most we can make on the trade. So $41 per spread is my maximum profit potential. If the market completely fell out of bed, the most I was going to be able to make was $41. So at initial glance, you're saying, is that really worth my time? Well, it certainly is, because number one, I only tied up $59 of capital. But even on top of that, I had 5 different ways of making money on the trade. If price action did fall out of bed, great, I can make money from that move. If it just kind of drifted slowly to the downside, I can make money there too. What if we get the dreaded sideways move? So instead of pulling back, we get the dreaded choppy sideways market. Well, I'm okay making money there as well. Even if this market moved straight against me, instead of moving lower like I expected, what if it moved to the upside? Well, as long as it stayed below my break-even point at 281.91, I can make money on the trade. Now, going back to mid-July when we put this position on, it was right in this sequence right here. Look what happened since we put that trade on. There was a couple of times during that trade that we were way underwater. Price action finally started to pull back for us. We had a little bit of selling right into here, right towards the end of July into early last week. Was that really a significant pullback? It really wasn't. If anything, it was a sideways consolidation. Well, it was enough for us to go ahead and close out this trade early last week. We bought the whole spread back for 9 cents, and it gave me a $32 profit per spread. I really was dead wrong on direction. We did not get a pullback on SPY, but it was enough. We did not get that move to continue to the upside, so we were able to make money. We made money in all three types of market directional movement. So up, down, or sideways, I was okay as long as price action stayed below 281.91. I made money from time decay adding up and from volatility decreasing. So I gave myself 5 different ways of making money on the trade. That's why I love these types of positions. And I get questions on this all the time from newer students saying, I don't want to sell premium. I don't like the risk to reward scenario. I want the bigger profit potential. And I agree. I love the bigger profit potential that long calls and long puts give us. The problem there is we only have one way of making money. We only make money if that stock moves in our favor in a big way, and it has to do so quickly. Otherwise, we're in trouble. By selling the call spread here, by selling some credit spreads, we're able to give ourselves more diversification. We give ourselves the ability to make that consistent profit, even if the market's not giving us those big directional moves. The power kicks in is when we use a combination of both approaches. When I buy calls and puts in certain conditions, when I sell spreads in other conditions, when you start to use those in combination with each other, that's when it starts to get powerful. And that's, I think, the missing piece for a lot of options traders. Everybody gets so attracted to the 500-600% returns that you can see from time to time when you buy calls and puts, but you miss out on that consistent source of income. And then again, like we just talked about, we're talking about less than $60 per spread to put this trade on. It's not a ton of capital required. It's really a no-brainer regardless of your account size. Now, the second trade that we talked about in the owner site last week was the Costco short call spread. On Costco, this again was back in mid-July. We came in and we sold the 220, 222.5 call spread, and we collected $67 per spread. What this means is I'm selling the 220 call, I'm buying the 222.5 call to make it a risk-defined trade, and I'm collecting $67 per spread to put the trade on. It's only tying up $183 of capital. You take a look at Costco, it's a $220 stock at this point, and I'm tying up less than $200 per spread to put the trade on. Pretty powerful approach because we're not required to have that $50,000 account, the $100,000 account. This is a very manageable position regardless of account size. Just like the SPY position, this is a bearish trade. Ideally, I want to have a move to the downside, but I don't need a huge move lower. I just need price action to stay below my break-even point, which was at 220.67. Well, this is actually a very similar pattern to what we saw on SPY. This is a very similar pattern to what we're seeing market-wide. We're not getting a lot of downside pressure. We might get some selling for a couple hours at a time, maybe a couple days at a time if we're lucky. But take a look at Costco. If you take a look at this chart pattern, if I were to tell you that we made money on this move to the downside, you're probably questioning that, whether that's possible or not, right? Because with a long put, if I bought a long put, there's no money to be made there. There's really no pullback at all. But because I sold the call spread, all I needed to have happen was price action to stay below my white line. Now, it was only below that white line for maybe 4 days, but that's all we needed. We closed out of the position for 13 cents. It gave me a $54 profit per spread, and I was really only right on this trade for 4 days. We really never got the big pullback. I gave myself 5 different ways of making money on the position. So if price action moved up, down, or sideways, I was okay as long as price action stayed below 220.67. I made money from time decay adding up and from volatility decreasing. So I'm increasing my probability of success long term. Do I have the home run profit potential that I would have with a long call or long put? No, I don't get that. But in exchange, I have a much higher probability of success, and that's what I'm looking to accomplish with these trades. So those were the 2 positions that we closed out here with the Options Express last week. Really nice profit there. We didn't get the frequency of trades that we wanted, and that's the position we're in right now with the low volatility. We're being pickier on the trades that we take. We were fortunate enough towards the tail end of last week, we did initiate a handful of new positions, and let's go ahead and talk about those here now. I've had some questions from some of our newer students saying, why aren't we placing more long calls and long puts right now? Well, we've already touched on it in this video. When you buy a long call or a long put, you need to have some big directional movement in your favor, and it has to happen in a timely manner. If it doesn't, you're going to get stuck where the time decay is just going to crush your position. This time of year, when you start to get into July, into early August, prime time vacation season for a lot of people, traders included, and that's when you start to get into the low volume environment. You're not necessarily getting the big directional movement back and forth, and this is a prime time to get those credit spreads on. Get that time decay working in your favor, give yourself 5 ways of making money on the trade, and then once price action starts to pick up again, and I fully expect it to do that as we start to get into the fall months, when we start to get volatility to pick up, we'll transition our approach a little bit and start to take more long calls and long puts. We're going to take advantage of the flexibility that options give us. We're not going to force one style to work. I'm not going to force long calls and long puts to work if the market's not very active. On the flip side, if the volatility explodes like we saw earlier this year back in the spring months, if that happens again towards the tail end of this year, we'll transition. We'll go back to buying calls and puts and give ourselves the bigger profit potential. Having that flexibility there, that's a big attraction for me at least to trading options, so we can take what the market's giving us. So let's talk about the couple of new positions that we put on here last week. I mentioned earlier, in a low volatility environment, we can still find trade opportunities. You just have to be more directional. And what I was looking for last week is some of the most overbought areas of this market, names that have already had really impressive moves to the upside. And one of those was on Apple. We had Apple earnings out last week. Apple made a phenomenal move to the upside, made new all-time highs. We're approaching some pretty strong overbought extremes in the near term. Doesn't mean that Apple can't head higher 6 months from now. I just think over the next few weeks, we're going to start to see some consolidation. We're going to start to see some pullback here. Very overdue. And it would be healthy if we did get that pullback. But I didn't want to just come in and buy a long put because I'm not necessarily convinced that the timing is right on this trade. I don't know if that pullback is going to happen immediately. I could fully see a period of consolidation kicking in. So that's why we went the route of selling the call spread last week. That way I still lean a little bit bearish, but I give myself more ways of making money. If it does chop sideways, we can still make money from that time decay adding up in our favor. What we did is we came in and we utilized the August 24th weekly options. Those have 19 days left to expiration. One of the adjustments that we've had to make here lately, with this service, we like to use a lot of weekly options. I've had to go a little bit farther out in time, an additional week or two in some cases, to collect enough premium. That's one of the adjustments that we've made to the low volatility. If the volatility was higher, we could sell the options expiring next week, the following week. But because that volatility is low, we've got to go out a little bit farther just to make sure we give ourselves a good risk to reward scenario. What we did here end of last week is we came in and we sold the 210, 212.5 call spread on Apple. So we were selling the 210 call and we bought the 212.5 call to make it a risk-defined trade. I was filled on this on Friday for 75 cents. Okay, so it's actually trading a little bit higher than that now, but let me go ahead and adjust this price down so you can see the risk reward on this trade based on my fill price. Getting filled at 75 cents, the $75 is the most I can make on this trade, regardless of what happens on Apple. I fully expect Apple to pull back. If it falls out of bed, if it completely collapses over the next few weeks, the most I can make is 75 bucks. Now you take a look at this risk reward scenario. I'm risking $175 to make 75. Some people get concerned with that because we're all taught initially when we get going with our trading careers that you want to make sure that your winners are larger than your losers. And that is important with a long call or a long put strategy. You want to make sure that that's true. When you're selling premium, you're never going to have a positive reward to risk ratio. It's always going to be negative. What I'm comfortable with is risking between 2 and 3 to make 1. I'm willing to accept that approach because we have so many ways of making money on the trade. What I'm not willing to accept is a risk 5, 6, or 7 to make 1. That just gets a little bit skewed against you. So in this case, I'm risking just over 2 to 1. Right? So I'm completely comfortable with it. The cool part about this trade, it's a $200 stock, but I'm only tying up $175 of capital per spread. So you can do this with a small account size. If I were just to come in and look at buying an in-the-money put on Apple, you could potentially be talking about anywhere from $700 to $1,200 per contract, but we're able to lower that down to $175 to sell the spread. This is a bearish position, but it gives us more of a neutral kicker. What I mean there is my break-even point is at 210.75. You can see it right here in my order confirmation box. That number is calculated by taking the short call. So I'm taking the 210 call that I'm selling, and we're adding on the 75-cent credit that we collected to put the trade on. I don't care if Apple moves up, down, or sideways. As long as it stays below that level, I can make money. So I've got almost $3 that Apple could continue to move to the upside, and I'm still okay. I'm protected. If it moves dead sideways or if it starts to move lower, I can make money in all 3 market scenarios. I also make money if time decay adds up and if volatility decreases. So it does give me 5 ways of making money on the trade. I also love these trades because they don't take a lot of attention to detail on a daily basis. If I were to collect 75 cents on this trade, which I did on Friday, my initial target is between 50 and 75% of whatever I collect to put this trade on. So if I collected 75 cents, I know right up front, if I want to go ahead and close this trade out, if I can close it out for between 19 and 38 cents, that'd be an acceptable range. So I could create a closing order the very day that I put this trade on. I can create that closing order, set it to a GTC or a good till cancel. That way, anytime over the next 19 days, if I can get filled inside of that range, that's great. I can have that trade filled and not have to be there by my computer all day long. It's a very easy trade to manage from start to finish, which is exactly why I love these types of positions. Now, with Apple trading up a little bit higher into the close on Friday, you may end up having a chance to grab this trade yet on Monday. So if you missed it last week, this is certainly a trade that's valid going into Monday morning. So we'll track Apple. We'll see if it ends up moving to the downside for us. If it does, we'll be able to take action and close out of that trade here over the next week or two. One of the other areas of this market that I was attracted to here last week was the financial sector. The financial names have been pretty impressive. Along with the tech names, they're very overbought. And what we did on Goldman Sachs last week is we sold another call spread. Very similar to Apple, we just found another very overbought area of the market, and we sold another call spread. We utilized the August 17 monthly option. So these options only have 12 days left. We don't have as long to hold this position here on Goldman Sachs. So much like Apple, we're selling a call spread. So I'm selling the 237.5 call. I'm buying the 240 call. We got filled on this trade at 80 cents here last week. It's already working in our favor. We've actually already got about almost 20 cents or $20 of profit here. We collected 80 cents to put this trade on. So let me adjust the price. I know we're already in the profit, but I just want you to see the overall profile of the trade at the entry price that we were able to get filled at. So we collected 80 cents. We were risking $170. So it was right around a risk 2 to make 1 scenario. The $80 is the most that I can make on the trade. Much like Apple, we would love a move to the downside, but we don't need a huge one. I just need this thing to stay below 238.30. If it does, I can make money. So going into next week, I've got over $4 that Goldman Sachs could move to the upside. On Apple, on Goldman Sachs, the neat part about selling a call spread, even though the market's overbought here, if it does continue to move to the upside, I'm still protected. It's already overbought. I don't expect it to continue to move higher. So in reality, I've got a lot of cushion for this trade to move against me, and I'm still okay. It starts to build in some layers of safety for me on these types of trades. It's a $230 stock, so if I were to buy a long call or a long put, you could potentially be talking about $1,000 a contract, but because we're using a spread here, I'm only tying up $170 of capital per spread. So it's a very reasonable trade regardless of your account size. As long as price action stays below 238.30, that's my break-even point, and it's calculated by taking my short call strike, 237.5. We add on the 80 cents that I collected to put the trade on. So I just need it to stay below 238.30. If it does, I make money. So up, down, or sideways, as long as it's below that level, I make money. I make money from time decay adding up and from volatility decreasing. So I do have 5 ways of making money on the positions. That's another one. And again, if I get rid of that order confirmation box, you'll take a look at the closing price. It's trading for right around 60 cents. So we've already got about $20 of profit on this trade. And that was basically in less than 24 hours of holding the position. So already working in our favor here on Goldman Sachs. Caterpillar, I can move through this one pretty quickly because it's very similar to the Goldman Sachs and Apple positions. We came in and we sold a call spread. We were utilizing the August 24th weekly option. So again, with 19 days left, just like we did over with Apple, we sold the 140, 141 call spread. We collected 37 cents or $37 per spread to put the trade on. My break-evens point's at 140.37. So I've got about $2 above me that this thing could move against me and I'm still okay. So if it moves up, down, or sideways, as long as it stays below that number, below that break-even point, I make money. I make money from time decay adding up and from volatility decreasing. So on all of these short call spreads, if we move dead sideways or if we close below these break-even points by a penny, we can still make money. That's the cool part about these trades. We're right at risk 2 to make 1, so I'm risking $63 to make 37. So again, $37, that's the most I can make on the trade, which doesn't look that attractive initially, but you've got to remember, I'm only tying up $63 of capital to begin with. You could put this trade on 10 times and still only have $630 of capital at risk. So very attractive trade regardless of account size. We also make money from the time decay adding up, from the volatility decreasing. So again, on any type of a short premium trade, we do give ourselves 5 different ways of making money on the position. So we are positioned slightly bearish going into the next couple weeks. We are expecting a little bit more of a market pullback here. The final new trade that we put on last week was on VXX. This is one of the VIX, one of the volatility ETFs that we track. We're looking for volatility to rise. All right, the VIX is at a very low level at this point. The volatility has been sucked completely out of this market at this point, which is no surprise given that the market continues to head higher on a daily basis. What I wanted to do with the VIX is position ourselves for an expansion in volatility over the next few weeks. Now, I didn't want to just come in and buy a long call because I'm not positive on the timing of the trade. If I buy a long call, that trade has to move to the upside in my favor immediately, otherwise I'm in trouble. So I wanted to be a little bit more conservative, give myself a little bit more time to be right, just in case that was early. So we came in on VXX and we sold the August 17 monthly options. So these have 12 days left to expiration. And we sold the 29.5 put, and we bought the 28.5 put to make it a risk-defined trade. We collected 38 cents to put this trade on. So we collected $38 per spread. If VXX starts to move to the upside, and that would happen if the equity markets start to pull back like we anticipate, in theory, volatility should expand. That would help our VXX position. Our break-even point's at 29.12. Okay, so we've got about $1.20 or so that this thing could continue to move to the downside, and we're okay. So selling a put spread is a bullish position. In this case, I know you're saying, well, okay, you're talking about being bearish to the market. Why would you want to be in a bullish position here? Because it is a volatility product. Volatility will expand as equities start to move lower. So as long as price action stays above 29.12, we can make money. We also make money from time decay adding up and from volatility decreasing. We're right around risk 2 to make 1. We're actually slightly better than that in this type of a position. We're only tying up $62 of capital per spread to put the trade on. Very flexible regardless of account size. And if you're trading a small account, you're talking about $60 per spread. If you've got a bigger account, a lot of these products that we talk about here, Apple, SPY, VXX, Caterpillar, they're very liquid products. So you can get filled with a decent sized position. I mean, on VXX in the past, I've had no issue getting filled on 40, 50 spreads. So you can really control your risk regardless of account size. So those are the newer trades that we put on here towards the tail end of last week. My entire portfolio at this point is definitely set up to benefit from markets starting to pull back. That's what I'm looking for going into early next week. So Monday, Tuesday, early Wednesday, I'd love to see some selling pressure kick in, and I want to see it sustain itself for more than a couple of hours at a time. What we've seen over the past few weeks is you get an hour of selling and the dip is bought every single time. We need to start to break that trend, and that's what we'll be looking for going into next week. Again, I don't need a huge move lower. The nice part about selling vertical spreads is if you just see chop kick in, we can make money from that type of a move. So we'll see what happens going into next week. If you have any questions at all, feel free to send me an email directly, mike@netpicks.com. Be more than willing to connect and walk through those trades in more detail. All right, so I'm going to wrap this video up here. Enjoy the rest of your weekend, everybody. We'll talk to you here next week for our next video.